We've done it. We've invested in a new company, and I'm sure you all know this name. You probably heard it before, and you may or may not know this already from my previous video, but we decided to invest in ticker symbol GOOG, Google. This company has been a long-term compounder with not only top-line revenue growth that has exceeded that of most other companies in the market, but its profitability reaching tens of billions of dollars with fast growth over a 10-year compounded rate of almost 20%. Now, if you follow me and you know my channel, you know I update my portfolio balance every single month at the beginning of the month, and we currently have $37,000 invested, with now we have this slice of the pie making up 14% of the portfolio being Google shares. And you know you've probably seen these. I have these little spreadsheets that I track where I make these for my investments, where I help keep up to date with numbers and run projections and where these companies need to be in share price for me to reach my $1 million goal by the age of 40, which is down below right here, where I need to be to reach that $1 million goal. Right? Now, I've made them for Salesforce, I've made them for Amazon, now I've made one for Google. If you haven't seen this before, which none of you have, this is my spreadsheet that I make for Google with these estimates, and we're going to go over this in this video and talk about where I think this company's moving forward, and we're going to go over a lot of things. We're going to talk about the revenue growth, we're going to talk about the operating margin, we're going to talk about the free cash flow, we're going to talk about share buybacks and the stock price and projections out into the future, and of course some notes as well, and talk about expanding market share, the market that it's growing in, and other comparable companies, as well as a YouTube deep dive into my own analytics, which we'll be talking about here shortly. So it's going to be a fun one. Stay tuned, and we're going to go over all that in this video. If you haven't seen me before, my name is Jordan. I'm a millennial investor, and I'd invite you to subscribe if you haven't already. And we have this dividend growth and growth portfolio that I share down below in the description. I update on every single video, which this is the growth portfolio, which has that new Google holding, ticker symbol GOOG. If you want to invest in this, or if you want to see it in yourself, or if you want to look at this beautiful brokerage that has this great animations and this great cosmetic appeal, it is through the link that is down below in the description. So check that out if you haven't already, and 126 people have done so far, and you'd help support me in the channel. But without further ado, let's jump straight into Google stock and look at this company's long-term track record. Now, this company has been growing at a massive level for years now. 1 year, 41%, 2 year, 26%, 5 year, 23%, and a 10-year compounded annual growth rate of 21%. Now, the profitability, the free cash flow, if you know me, that's one of the main things I look at. That's one of the most important things of profitability. A lot of times I actually value free cash flow more than the actual net income because it's actual cash generated that can be used for things, which we're about to talk about in a second, which is share buybacks that can be used to buy back stock or to pay out dividends or to purchase other companies. Free cash flow, in my opinion, is more valuable than net income in many cases. Now, the free cash flow has been growing at a comparable rate as well. Over the last 10 years, over the last decade, it's grown almost 20% per year compounded. So you can see in 2011, it put up $11 billion of free cash flow. And then 10 years later in 2021, it put up $67 billion. So you can see that's about a 6x in free cash flow in the last decade. So that is a massive uproar. Now, what is this company doing in the future? We looked at all these past numbers, and these are some of these numbers that it's done in the past. If you want to pause this as I'm scrolling through, and if you want to look over any of this, you can. But what is this company going to do in the future? Now, if you don't know me, I like to make projections that are extremely conservative. And if these projections are conservative and it's still an attractive buy-in price, that's where I want to be investing in. Because if you look at this, my projections on a bear, mid, and bull case is 4, 5, and 6% revenue growth. Now, is that reliable? Is that opportunistic as an investor? Do we think this is realistic? Do we think a 6% revenue growth rate is going to happen for Google? Well, according to this long-term track record, they've been growing at a 10-year compounded rate of 21%. Now, the last year, it's slowed down. You can see the quarterly numbers are finally starting to slowly grow a little bit slower than they were before, but even the most recent quarterly growth, which I'm highlighting right here, grew 13%, and last quarter at the beginning of the year grew 23%. So they're still growing in the double digits. So my conservative growth rate of just 6% projected is very conservative. The free cash flow margin of 25% is also very conservative. So if you take their numbers, you extrapolate it out, you get this revenue, you get this free cash flow, and divided by the shares outstanding and their projected future market cap, this would give them a price of free cash flow at this conservative rate of just 19, which is already below what it's trading today. Now, why do I think that this company will keep growing? It's easy to look at a company of this size and see that their annual revenue is now $250 billion plus and growing by the day, and it's easy to probably think to yourself, man, this has got to be coming to an end soon. You look at companies like Amazon, a company that has almost a $500 billion in revenue, and you got to think, my gosh, at some point it's gotta stop, right? Well, you wouldn't be wrong in thinking that, but that's not exactly the way that you have to think about these long-term, large-scaling internet companies. Because you look at some of the growth trends. There's a couple of things I want to talk about. If you notice in my little spreadsheet here, it's mostly split in the growth into 3 different categories, like right here. We have the total revenue growth, which is this column. Next, you have Google search. Obviously, when you type something into Google, that's their main core business. Next, you have YouTube, which is another segment of their business. And then next, you have cloud. So I want to talk about YouTube and cloud by itself. Now, these, I think, will grow faster than search, more than likely over the long term, quicker than that of Google search, but we'll see. Now, let's talk about cloud. Cloud computing has not only grown a lot in the last decade, but it is projected to grow even more in the next decade. We could talk about growth rates, okay? There's different estimates and different rates that are being projected over the next 5, over the next 10 years. And I could talk about that and I could discuss what I think it's going to grow at. But at the end of the day, I don't know. I'm not some professional economist, and even the people that do this for a living know that they can't properly forecast on an accurate level what this market size will grow to. What I do know is that it is very, 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 very likely, almost a certainty, that this market size for cloud computing and SaaS, software as a service, will continue to grow. We could argue about the rates. It might be 5%, it might be 10% a year, it might be 20% a year, but I think we can all agree that this will continue to grow. Now, even one of my own companies, my largest investment, going back here, you can see that my number one investment in the portfolio on my portfolio tracker here up top, my largest investment here is Salesforce, ticker symbol CRM. Now, they are a software as a service company. In their own projections, this is only a couple weeks old. They just came out with this, that their 2026 total addressable market, which once again is a software company, is projected to grow at 13%. So even my own investments, their own projections, are following up with these market analysts for growing the market size 10, 15, 20% over the next decade. Even Salesforce's own numbers say 13% compounded growth. Now, the next thing I want to talk about is YouTube. We've talked about the cloud. We know that the cloud is going to grow, but how much will YouTube grow? Because we know search, that's their old core business, that's their cash cow, that's where they reap all those rewards, all those big profits for shareholders. But the next one I want to talk about is YouTube, because we talked about cloud, and cloud is projected to grow. And as revenue growth continues to come from Google Cloud, I expect the same thing to happen from YouTube. So let's jump into these statistics. There's about 77% of people 15 to 25 that are using YouTube by age group. If you look at 56 plus, it's down 67%. And these are only people that log in and use the product as of the third quarter of 2020. So these numbers are a bit old, but this just gives you an idea. Obviously, the older generation does not use it. And this follows up with my own revenue metrics. This is my own audience. Out of the thousands of people that watch my channel, you can see that the vast majority comes in this age range of between 25 to about 45 years old. That prime time age where you're around me. So I'm actually 23, so I technically fall just below this. But the vast majority, even if we extend this between 18 and 54, that's where almost all the views come from. Everybody that's 55 and up, that makes up for about 6.8% of all views. Less than 7% of views come from my channel that are people 55 and up. Now remember, my content is even skewed towards the older demographic, which is investing. Typically, people that are into finance or into investing are typically 40, 50, 60 years old. And even with my content being focused on the older generation, it still targets the younger people because that's who's on YouTube, that's who's watching it. Now, why is this important? Because the old people don't watch YouTube. The old people watch TV. They don't spend nearly as much time on their phones, and that obviously bodes well for YouTube. It even says here in this article, YouTube reaches more millennials than all the TV networks combined. On mobile alone, a good look at YouTube statistics reveals that the platform reaches more viewers between the age 18 to 34 than any and all the TV networks combined. Furthermore, it also says that video ads get the eyes of regular TV ads at 3 times the rate. This is more important because all people are 3 times more likely to pay attention to online video ads over television ads. They're twice as likely to give their attention to a YouTube over even an Instagram or Facebook ad. No doubt that has a lot to do with the platform's targeting capabilities. And then lastly, it also says that people watch more YouTube on their TVs than Netflix. It says here that over 94% of consumers who stream services to their TVs watch YouTube compared to 75% of those who watch Netflix. So these are actually numbers on their TVs that are beating out that of Netflix, and obviously far more than that of old school channels. Now, obviously, this leads this company to produce massive profits. If you look at the company's balance sheet, you can look at the most recent quarter. Now, keep in mind, this is with this company actually spending a lot of their cash in the last year. They have $125 billion on the balance sheet. I'm going to repeat that just for how crazy it is. $125 billion versus their long-term debt that comes in at 10. Their net cash position is over $100 billion, about 115 to be exact. And with that much cash being generated from their core YouTube search business, it leads to this company putting out news like this. Alphabet announces a $70 billion stock buyback. It's a major step up from the last year's authorization of $50 billion and an authorization of $25 billion in 2019. So when you see cash piles like this is the opportunity where the company gets to put the capital to work. You can go over to M1 Finance here, hop over to the research tab, type in the ticker symbol GOOG, and you can look at the last year. You can see that it's down and down and down. Let's look at the 2-year chart. You can see that it is almost back to where it was 2 years ago. It's starting to get to the levels of where it was in February of 2021. We're now at $96 a share. And so here's the cool part. Google recognizes this. They know that their share price is down and their valuation is down. So they can use this cash to start buying back stock like they have, and they finally get to use that massive cash position for good use. Like I said, 2019, the share buyback program was $25 billion. The next year in 2020, they doubled it to $50 billion. And then now here in 2022, they're increasing it to $70 billion. So not only are they buying back shares, but they're buying back more shares each year. And that's what has led the share count ever since the peak in 2019 when they started to go from about 14 billion. Now they're sitting at about 13 billion, and it's going to cross below that very, very soon, which is very likely. Which is why I project also in my numbers, you can see at the share count over time, I project will go down at least 2.5% in share count every single year, which is another form of almost like a dividend. It's return capital. This company doesn't pay out a dividend, but it's another form of return capital that obviously gives you more value as a shareholder, which makes these free cash flows more valuable to you as a shareholder. So for these reasons, whether it's YouTube being more profitable than that of TV ads, whether it's the baby boomers being replaced by Gen Z and millennials who spend more time on YouTube than the past generations, or even my own YouTube analytics backing up these numbers, and the cloud projecting to be growing at 10+% year over year over the next decade, it's all these reasons that I believe that Google is an opportune time to be buying shares. This is not financial advice, do your own research, but this company pretty much does one thing and it just goes straight up. And considering this company was trading at an all-time high just about a year ago at about $150 plus a share, today I bought my shares at 97. So considering I bought this company at about a 35% dip, I'm happy with that. And that is why I am owning Google, while it will continue to be a holding in my portfolio, and I don't plan on selling anytime soon. Check out all the stuff down below in the description if you didn't already, including this M1 Finance platform that I'm showcasing this on, and you'd help support me and the channel, and you'd get $10 for doing so. Thank you so much for watching, and I'll catch you guys next time.